Welcome to the November 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV. United States Economic Conditions and Recession Prospects. Dr. Peter Mavromatis, MAV, opened the discussion by addressing market speculation around the potential for a US recession, which he firmly refuted based on the current available evidence. Following the longest government shutdown in US history, limited data releases had emerged, with the extended shutdown coinciding with a number of significant market sell-offs. Market commentators have frequently cited indicators such as the Challenger job cuts data and the University of Michigan consumer sentiment figures as evidence that a recession was already underway. However, MAV emphasized that other broader private data releases contradicted this narrative. Most markets have come under pressure recently, with the NVIDIA quarterly results and upgraded December quarter guidance providing a potential inflection point for the sell-off. The San Francisco Federal Reserve's proprietary labor market stress indicator came in at 5, a level historically inconsistent with accelerating unemployment. Nor is it consistent with the National Bureau of Economic Research (NBER) definition of recessions, suggesting a minimal likelihood of a recession. The indicator's historical accuracy in aligning with NBER defined recessions provided further confidence that the speculation around a labor market collapse was overstated. MAV attributed recent labor market movements primarily to supply-side shocks rather than being driven by a demand-side collapse. Labor force size and non-farm payroll numbers since the first half of 2023 remains broadly aligned, although the data only extends back to mid-2025. Other real-time stress indicators continued to suggest the US is not experiencing recessionary conditions, despite a number of concerning individual data points. The Challenger job cuts data released in October revealed substantial job reductions, representing the highest level since the global financial crisis, after excluding the pandemic-induced shutdown. February and March had witnessed the most significant change as tariff regimes were announced and implemented, while the more recent October data also showed another potentially concerning inflection point. The October data revealed that 20.3% of job cuts were attributable to the adoption of artificial intelligence, a dramatic increase from the year-to-date figure of 4.4%. The result indicated an accelerating business-level AI adoption. Further, it was highlighted that recent information technology graduates were experiencing considerable difficulty securing employment, reflecting this displacement trend. Whilst acknowledging the near-term negative employment effects, MAV pointed to long-term productivity enhancements from AI adoption, which is particularly relevant for economies such as Australia, which requires productivity improvements. Dr. Kingsley Jones, KJ, elaborated on the substitution of capital for labor occurring through the rapid AI deployment. He noted that a significant portion of US GDP growth is now being derived from AI-related capital expenditure, particularly data center construction in locations such as Texas. The hyperscaler companies were engaged in a competitive races to establish productivity frontiers through their capital investment. However, KJ raised the potential for a composition problem whereby widespread labor substitution would reduce consumption as service robots and humanoid robots do not purchase consumer goods or services. He referenced an alleged conversation between Henry Ford and a union representative regarding automation's impact on consumer demand, drawing parallels to current circumstances. Given that approximately 70% of US GDP comprises consumption, significant capital for labor substitution could create substantial economic difficulties, though the timeline for any potential demand collapse remained uncertain. From an investment perspective, KJ acknowledged the appeal of capital substitution beneficiaries, whilst recognizing the paradoxical nature whereby additional job cuts might prompt Federal Reserve rate reductions, narrowing credit spreads and the potential of further capital expenditure. Stephen Duchesne, SD, concurred, adding that we are witnessing the fastest ever industrial revolution and that this would likely have a host of consequences. Consumer inequality and financial stress. Indicators. MAV presented evidence of widening disparities between wealth cohorts, which is manifesting in consumer sentiment and credit delinquency data. The University of Michigan's November consumer sentiment reading registered as the second lowest on record, though MAV noted the survey's blue state political bias. Critically, sentiment weakness extended across age, income, and political cohorts, with one notable exception. Households in the top third of stock ownership who reported rising confidence, which is likely attributable to stock market strength prior to the recent fortnight's decline. Consumer credit delinquency rates have also increased across categories, with student debt data distorted by debt reduction programs and payment holidays. Auto loan delinquencies, whilst elevated, registered below MAV's expectations, whereas credit card delinquencies had increased dramatically over the preceding 12 months, indicating mounting stress on US consumers. MAV commented that the rise in inequality in the period since the pandemic is having implications that extend beyond social cohesion and is now affecting economic, political, and financial market outcomes. MAV referenced Victoria's crime outbreak reaching levels unprecedented since the police strike of the early 1920s. SD emphasised the accelerating bifurcation between asset holders and non-holders, noting Sydney property price movements from $5 to $6 million a decade ago to $50 million or even $100 million currently, whilst younger cohorts struggled with rental payments. This inequality also related to debt levels, including sovereign debt across OECD nations and private debt. SD also pointed to subprime delinquencies, loan covenants, and potential contagion risks, though these are not at global financial crisis levels. As further evidence of inequality across household income and balance sheets, MAV highlighted the outperformance of consumer discretionary stocks versus consumer staples stocks seen since mid-year, although he did note that in recent weeks there has been a rapid reversal when sentiment shifted. Monetary policy settings and inflation outlook. Mav maintained his long-standing position that the US neutral rate remains at approximately 4%, which is in contrast to the Federal Reserve officials' consensus that is currently around 3% across the 19 FOMC members. 3 officials estimated the neutral rate at 2.6%, with most clustered between 3.0 and 3.1%, representing an approximately 100 basis point divergence from MAV's assessment. Following the last October rate cut, he suggested the Federal Reserve had potentially exited restrictive territory during a period of elevated inflation. Inventory rebuilding at tariff-inflated prices would generate pass-through effects based on management guidance statements over recent months suggesting persistent inflation. The dot plot representation indicated a diminishing dovish consensus, with increased dissent among officials, which is partly attributable to Jerome Powell's tenure coming to an end. Interest rate markets assigned only a 27% probability to a pre-Christmas cut as at the meeting date, revised from 40 to 42% several days prior, indicating a December cut was looking less likely with potential delays until March 2026. MAV projected possibly 2 cuts by June, absent recession or labour demand collapse beyond supply reduction, but that these might prove to be a policy error. The Federal Reserve has announced the termination of quantitative tightening in the coming weeks due to liquidity concerns, specifically the Secured Overnight Financing Rate, SOFR, which is now trading at a premium in overnight markets rather than the typical discount. Whilst acknowledging QT's termination as appropriate given potential liquidity risks, MAV characterised the 2 most recent rate cuts as likely errors given current inflation levels. He projected these decisions would likely entrench inflation throughout early to mid-2026. As an aside, historical analysis from the San Francisco Federal Reserve examining 150 years of tariff policy data indicated tariff shocks negatively impacted aggregate demand in the shock year and subsequent year and will typically reduce inflation and increase unemployment. However, MAV noted conflicting evidence from Australian computable general equilibrium work suggesting tariffs increased inflation absent rapid technological progress, thereby raising questions about the historical findings' inflation conclusions. For Australia, cash rate futures indicated only a 10% probability of a pre-Christmas cut, with a much reduced chance of any move in December 2026. The has come about following the Reserve Bank of Australia's September quarter inflation data, which substantially exceeded expectations and prompted the immediate abandonment of November and December cut possibilities. The RBA's quarterly statement on monetary policy projected a 2.0% annual economic growth rate driven by housing construction, which is targeting 1.2 million homes by decade's end, although MAV expressed skepticisms regarding this being achieved. The RBA is also forecasting CPI peaking at 3.7% by mid-2026 as wages growth decelerates. This will represent real wage decline during a period of continued cost of living pressures. This has been softened by 2025 rate cuts and competition-driven mortgage rate reductions and has led to stronger spending and a recovery since early July. The RBA is also looking to unemployment stabilising around 4.3 to 4.4%, though MAV emphasised productivity improvements are essential for managing inflation in the face of accelerating growth, noting 12 months of policy inaction. Market concentration and passive investment dynamics. The investment landscape has undergone a fundamental transformation, with passive investing now surpassing active management on a global basis. Boyd highlighted that this shift has driven unprecedented concentration within equity indices, noting that the top 10 companies currently represent 26% of the world index, a substantial increase from 10% a decade prior. This concentration has emerged as investors have increasingly allocated capital to passive vehicles due to the underperformance of their actively managed counterparts. This is primarily attributable to these vehicles holding large technology companies in concentrations that few active managers can replicate. Boyd emphasised that this dynamic has created a self-reinforcing cycle wherein capital flows disproportionately into the same concentrated holdings simply because others are doing likewise. Particularly striking is that the top 8 companies in the Morgan Stanley World Index are identical to the top 8 companies in the NASDAQ 100, effectively transforming standard global equity exposure into what Boyd characterized as an investment in large technology firms. This represents a significant departure from most investors' intended portfolio construction when investing in global equities and constitutes a concentrated wager on artificial intelligence infrastructure development, bringing substantial concentration risk. Artificial intelligence investment concerns and cash flow dynamics. Boyd addressed the substantial investment boom underway in artificial intelligence, with trillions of dollars expected to be deployed by major technology companies over the subsequent 5 years, whilst also emphasizing the absence of certainty regarding returns from these investments. Drawing upon recent visits to China and Japan, Boyd observed that Chinese companies are achieving exceptional artificial intelligence returns despite lacking access to superior semiconductor technology, having been compelled to invest in their own proprietary technology development. Whilst not yet matching NVIDIA's capabilities, Chinese firms are making good progress, as evidenced during a visit to Yum China, which demonstrated impressive artificial intelligence applications in operations without utilizing United States technology. Boyd expressed concern regarding circular investment patterns amongst companies including OpenAI, NVIDIA, and Microsoft. He noted that whilst OpenAI generated revenue of $13 billion with losses of $8 billion and has a current valuation of $500 billion, speculation is that it could engage in an initial public offering at $1 trillion. The artificial intelligence expenditure is materially affecting technology company fundamentals, with Alphabet serving as a primary example. Boyd noted that digital advertising has grown from 16% of the global advertising market when GuardCap first invested in Alphabet in 2010 to an expected 70% in the current year, suggesting the progress is in its final stages. Despite Alphabet's position amongst leading artificial intelligence companies with expected continued profit growth, Boyd forecast that the company would exhaust its entire cash balance by 2028 if it maintains its current share buyback program. Specifically, free cash flow of $73 billion in 2024 is projected to decline to $50 billion in 2025 and $40 billion in 2026, representing a decline exceeding 40% over 2 years. This deteriorating cash conversion, which historically exceeded 100% for Alphabet, has fallen below 40% due to its capital expenditure to sales ratios doubling from approximately 12% in 2023 to 23% in 2025. This pronounced deterioration in cash metrics constituted the primary rationale for exiting the position, alongside competitive concerns from alternative large language models that could potentially threaten Alphabet's current near-monopoly in search activity. Macroeconomic risks and historical parallels. Boyd identified substantial macroeconomic risks emerging from policy experimentation, noting that the United States' average tariff rates have reached their highest levels of the century, occurring alongside a burgeoning fiscal deficit. The Congressional Budget Office estimates that the legislative package will add more than $3 trillion to the federal deficit over the subsequent decade, whilst leaving approximately 12 million individuals without healthcare coverage. The budget deficit is estimated to exceed 6% of gross domestic product in 2025, with national debt approaching 100% of gross domestic product. Yet in a decade's time, the budget deficit is projected to remain above 6%, with debt to gross domestic product rising to nearly 120%. Boyd suggested bond markets may ultimately respond to mounting fiscal concerns through yield increases. Additionally, the equity share of total household financial assets has reached an all-time high of 31% in 2025, surpassing the previous peak of 25% in 2000. A reversal to more normal levels could therefore carry significant implications for consumption and gross domestic product growth. Boyd drew instructive parallels to the dot-com boom, having managed the strategy since 1996 and experiencing that period directly. In 2000, infrastructure builders, including Cisco Systems and Corning, lost 30% of value within 1 week when results slightly missed market expectations, with Cisco experiencing peak-to-trough declines of 88% and Corning 99%. Neither company has returned to 2000 peak prices 25 years subsequently. When KJ inquired regarding parallels with the dark fiber era, when telecommunications companies with high free cash flow overbuilt fiber networks, Boyd acknowledged that whilst the infrastructure was ultimately utilized, the speed of the excessive build-out likely precipitated the damaging market crashes between 2000 and 2002. Boyd emphasized that the concern is not whether artificial intelligence represents beneficial technology, but rather that the build-out pace is excessively rapid, particularly given Chinese companies' ability to achieve comparable outcomes at significantly lower costs. Strategic positioning and quality factor dynamics. Rather than investing in artificial intelligence infrastructure builders, Boyd explained the preference for companies possessing unique proprietary datasets. This would enable companies to develop competitive advantages through artificial intelligence integration without requiring massive capital expenditure. Examples included Novozymes, a Danish biosolutions company maintaining a library of some 20 million enzymatic structures and more than 40,000 indexed biological strains. This data set could allow artificial intelligence to accelerate the development of new biosolutions that startup competitors cannot replicate. Yum China, which operates KFC and Pizza Hut through joint ventures, maintains a loyalty scheme encompassing over 500 million members and enabling artificial intelligence-driven personalization to deliver much more targeted offers. Boyd characterized Yum China as now being fundamentally a technology business despite its restaurant operations, as artificial intelligence enables restaurant general managers to oversee between 2 and 5 stores each, compared to historically managing a single stores. thereby allowing an accelerated expansion using current resources. KJ referenced the recent Massachusetts Institute of Technology MIT research paper indicating pessimistic results regarding artificial intelligence adoption across businesses generally. Most chief executives remain uncertain as to the implementation of AI, despite a willingness to do so. This represents a challenge distinct from the rapid adoption observed amongst Chinese restaurateurs. Addressing the healthcare sector's quality characteristics, Boyd explained they are taking a case-by-case approach necessitated by substantial pressure on healthcare systems globally. The sector is facing increasing activity levels from aging populations with the focus on companies facilitating system efficiency improvements. This includes companies like United Health, who are driving value-based healthcare through exceptional data reserves, and Illumina, who are advancing gene sequencing for early cancer detection, which is resulting in higher survival rates and significantly reduced treatment costs. Regarding quality factor dynamics broadly, Boyd presented data demonstrating that price-to-earnings premiums for quality growth managers have compressed substantially. Historically maintaining price-to-earnings premiums of 40% to 50% over the preceding 30 years, this premium reached approximately 100% before contracting to merely 10% presently, a rarely observed level. This compression partly reflects the market's price-to-earnings expansion, which has been particularly concentrated in the preceding 2 to 3 years. Any normalization would likely require a significant market correction. A new world order and required investment approach. Jay Sivapalan commenced his presentation by emphasizing the significant structural changes occurring in the global economy, particularly regarding supply chain reconfiguration, defense spending, and artificial intelligence development. He referenced historical data spanning approximately 200 years, demonstrating a clear correlation between global trade volumes and GDP per capita growth, arguing that whilst trading patterns and partnerships may evolve, overall global trade volumes are unlikely to regress. The United States, by deliberate policy design, is suppressing consumption of internationally produced goods whilst elevating capital investment in defense, automotive manufacturing, and AI sectors, with an expanded focus on service exports. This represents a 5 to 10-year repositioning of the American economy rather than a short-term policy adjustment. Europe faces challenges stemming from sustained underinvestment in capital projects, with defence spending representing only the initial phase of what Sivapalan anticipates will be substantially increased capital expenditure across multiple sectors. Japan continues emerging from 4 decades of economic stagnation, but is now experiencing genuine inflation and growth dynamics that could position it as a positive wildcard over the coming decade. China is transitioning from its previous model of urbanization and infrastructure development to establishing dominance in automotive manufacturing, electric vehicle and battery technology, rare mineral processing, and developing its own artificial intelligence ecosystem. Sivapalan suggested the likelihood of 2 competing yet coexisting technology frameworks globally, particularly regarding AI development and deployment. Australia will likely confront its own transition challenges, having relied heavily on commodity exports, particularly iron ore and coal to China, for approximately 25 years. He noted an observable pullback in demand for these traditional commodities as Japan and Korea accelerate their transitions toward renewable energy sources, whilst China pursues its own energy transformation pathway. Australian Economic Outlook and Monetary Policy Assessment. Sivapalan characterised Australia's recent inflation pulse, which is testing and expected to exceed the Reserve Bank of Australia's 3.0% target band, as predominantly policy and supply-driven rather than demand-driven. He outlined that the labour market lacks the characteristics of overheating, with approximately half of all employment growth over recent years originating from the public sector rather than private enterprise. The RBA's 3 rate cuts earlier in the year were explicitly designed to facilitate a handover from government sector employment growth to private sector job creation. Contributing factors to the current inflation environment include energy sector reform, transition pathway implementation, and supply constraints in housing construction, which is experiencing renewed activity after a prolonged depression. Sivapalan projected that consumer spending, represented, should begin recovering due to lagged effects from the 3 rate cuts, though overall economic growth in both 2025 and 2026 would likely remain below economic potential. He assessed Australia's GDP potential at between 2.5 and 3.0%, notably higher than the RBA's apparent assumption of approximately 2%. When questioned by MAV regarding this discrepancy, Sivapalan attributed the difference primarily to divergent productivity assumptions, noting that whilst the RBA maintains expectations of suppressed persistent productivity issues, his team anticipates artificial intelligence and related technologies will drive improvements from currently muted levels. The critical factor for economic performance remains the labour market, where private sector employment has been tepid whilst non-market or government sector employment has driven gains. Should the RBA pause for several months to assess the current inflation pulse, this would slow the crucial transition from government to private sector employment leadership. Despite these dynamics, Sivapalan maintained that the RBA's next move remains likely downward, with one additional rate cut carrying greater certainty, potentially followed by a second, particularly if government sector employment weakens further, given fiscal constraints limiting continued stimulus provision. Fixed income market opportunities. The current environment presents substantially enhanced return prospects compared to 2 or 3 years prior, with the asset class seeing more attractive yields across government bonds, state government bonds, and credit markets of various qualities. Benchmark returns in Australia, excluding cash, have generated returns of 5.0 to 7.5%, whilst higher yielding markets have delivered 6.0 to 8.0% returns. Active fund managers, including Janus Henderson, are now delivering returns in the 6.5 to 8.0% range net of fees, properly fulfilling the asset class's position between cash and equities. Sivapalan addressed the persistent question of whether the environment favours active management, noting that, like markets and businesses, active management experiences cycles. Over the past 25 years, approximately 3 separate 2 to 3 year periods presented significant challenges for active management, whilst other 5-year blocks have proven to be considerably more favourable for managers willing to employ multiple levers across rates, credit, and state government bonds. Credit market dynamics. Investment-grade companies, encompassing the largest corporations across Australia, the United States, and Europe, maintain robust positions from a debt holder perspective, typically carrying lower gearing than 2019 levels, generating stronger positive cash flows, and holding longer debt tenors that reduce refinancing risk compared to pre-COVID conditions. However, this strength is not uniformly distributed, with idiosyncratic issues affecting various industries, regions, and particularly lower credit quality segments. Australian corporate insolvencies have increased significantly, likely peaking currently, with concentration in construction, building, cyclical companies, and highly leveraged consumer discretionary sectors. These failures reflect delayed impacts from the high RBA interest rate environment, including spectacular defaults and rising delinquencies, interest capitalisation, and loan extensions. Fortunately, much of this distressed exposure has not penetrated professional financial planning or wealth management channels, instead concentrating amongst self-managed superannuation funds and small businesses advised by suburban accountants offering high-return property investments generating 15 to 20% returns that are now experiencing defaults. In the United States loan market, payment-in-kind arrangements, where companies capitalise unpaid interest and extend tenors, have risen from below 5% in 2019 to approaching 20% currently. Whilst not yet constituting a systemic concern warranting panic or extensive credit protection purchases, this warrants careful monitoring and potentially upgrading portfolio credit quality, tenor, and liquidity. Credit protections have weakened substantially, with covenant-light loans increasing dramatically from pre-global financial crisis levels through post-GFC 2017 and the 2018 to 2024 period. The ultimate catalyst for broader problems would be a 2 to 3% rise in unemployment rather than marginal 0.1 or 0.2% movements, though Sivapalan does not anticipate this scenario, absent a left-field event. Australian credit spreads have maintained a persistent disconnect from equivalent US A-rated credit spreads over recent years. Whilst both markets have rallied with narrowing spreads, Australian credit maintains wider spreads, providing investors with enhanced protection cushions and superior carry that has enabled outperformance versus global credit. Economics. The committee discussed the current market environment with particular focus on fixed income dynamics following the presentation from Janus Henderson. Members noted the significant opportunities emerging in active fixed income management, particularly given the distortions created by retail investor flows into marketed products like bank hybrids. The committee observed that hybrids were trading at premiums, approximately $105, while facing calls at par, $100, suggesting poor value relative to other fixed income opportunities. In contrast, the semi-government bond sector was highlighted as offering attractive spreads with notable differentials between state issuers, particularly Victoria and Queensland, that historically traded much closer together. The committee acknowledged that Australia's 10-year government bond yielded approximately 4.40 to 4.47% represented close to fair value relative to long-term neutral levels. The discussion also encompassed the significant yield differential between Australian and US investment-grade credit, particularly in the single A-rated bucket, which presented relative value opportunities in the domestic market. Members noted the growing universe of Australian corporate borrowers was creating enhanced opportunities for active management. The committee discussed the defensive versus growth income dynamic, observing that defensive assets were currently offering higher yields than the growth component based on manager forecasts. Considerable attention was given to the implications of upcoming economic data releases, with members expressing caution that delayed US payroll reports would occur after the next Federal Reserve meeting, creating uncertainty around rate expectations. While Janus Henderson's house view incorporated productivity improvements supporting higher GDP growth alongside further rate cuts, the committee members expressed scepticism about Australia achieving rate cuts by the end of the financial year given current labour market conditions. Portfolio construction. The committee reviewed the portfolio's strategic positioning and agreed to maintain the current growth-defensive split at 64%, 36%, versus the strategic asset allocation targets of 60%, 40%, representing a modest overweight to growth assets. All committee members expressed comfort with this positioning, with several noting they would not want to increase growth exposure further given potential correction risks and significant upcoming economic data releases. Within growth assets, the committee reaffirmed satisfaction with the slight underweight to Australian equities while maintaining overweight positions to small caps both domestically and internationally, acknowledging this positioning had performed well in recent months despite some recent market volatility. The committee devoted particular attention to the defensive allocation, specifically the composition of the duration exposure. Following a discussion of opportunities in semi-government bonds highlighted in the Janus Henderson presentation, members explored whether the Australian duration mandate should explicitly incorporate semi-government exposure beyond pure government bonds. The committee confirmed that the current composite bond index benchmark already included a 10 to 15% credit exposure while also including exposure to semi-government bonds. This provided comfort that active managers had sufficient flexibility to capture relative value opportunities between states. MAV suggested that, given the 10-year Australian government bond yield is currently at 4.45%, domestic duration could be increased if the committee felt another defensive asset class deserved a reduction. SD suggested the cash holding, currently 1%, could potentially fund additional duration exposure if required. Though this was not pursued, as members noted, the 1% cash minimum was appropriate for managed account platform requirements. The committee agreed to maintain a watching brief on the portfolio's defensive asset composition, with the current mix of Australian duration, global investment-grade credit and cash deemed appropriate for the present environment. No rebalancing actions were recommended, with members preferring to allow recent portfolio changes time to work and await upcoming economic data before making further adjustments.